everyone, thanks for joining. In this video I would like to give you an introduction to the capital asset pricing model and in particular to the formula and its components. You may have seen the formula before, especially useful for valuation purposes if we want to understand the expected return of an asset. So let me start explaining the formula. So we have overall, that's what we want to calculate, expected return of an asset. If we use it for company valuations, here we use this for the return on the equity. Expected return of an asset E, return E, that's why we call it RE, E, expected return E, also known as R, RE, return on equity. Yeah, return on asset, return on equity. Also cost of equity or equity cost of capital, all the same. Main thing here, it's a bit misleading. Why? It makes sense to me that we call it cost of equity or equity cost of capital. It's all clear, but then we call it return. Return for me sounds quite positive, whereas cost sounds quite negative. So why can we use it interchangeably? Main reason is it's the same value. It is just dependent on from which perspective we are looking at this. If we look from an investor perspective, then it's our return. We invest in the company, we have bought shares, so we give the company money and we expect a return depending on the risk profile, either higher return or lower return. That's why this is our expected return as a shareholder in this asset, in this company. From a company perspective, to raise equity, we don't get equity or we don't get capital for free. So we have to pay our shareholders in form of dividends some money, and the price of raising equity is basically our cost of equity. So here we can use it the same, expected return or cost. The difference is which perspective we are looking from. Beta I is the systematic risk of an asset. Beta risk, systematic risk of an asset I. Here again, we talked about this in another video. We are concerned with the systematic risk. The exposure of this company to systematic risk, the exposure of this company to natural disasters, geopolitical issues, inflation, interest rates, COVID-19. We are not concerned about risks that relate to firm-specific risks like change of CEO, production issue, because we assume this can be diversified. So this is our systematic risk of an asset. If our beta is higher than 1, it means the asset is riskier than the market portfolio. If it's smaller than 1, then the asset is less risky than the market portfolio. And if it's equal 1, then it means the asset, the company, is equal in risk to the market portfolio. Expected return M, this is your market portfolio. if you invest in a broad market, let's say S&P 500 biggest companies by market capitalization in the US, you would expect a return, let's say 12%. This is your market return, expected return market. And then you have a risk-free rate. Risk-free rate is usually a long-term debt instrument, because as we know, debt instrument is less risky than an equity instrument, less volatile. So usually we do long-term US Treasury bonds, especially from a government, to use this as a starting point. The difference here, very important, the difference, it's called market risk premium. Is the additional risk or return you would require compensation for if you invest in a market portfolio. And then plus RF, this is basically your starting point on the y-axis. And then this is how you measure. So you start with your RF, that's your starting point. You would not start from zero, because you know you can always get a risk-free return if you invest in government long-term bonds. They can use taxable income from its population. They can affect the policy around cash in their country. So what we do, we start with RF, then we look at very broad market portfolio. We look at, okay, how sensitive is the single asset to the market portfolio, and this is how we get our expected return on my asset. Yeah, we use this as an input for our weighted average cost of capital, which I will explain in another video. Thank you so much for listening. See you later. Bye.